Hey guys, welcome back to the Bitcoin Fortress podcast, building one block at a time. Today is Sunday, May 31st, 2026. We are at block height 951860, Moscow time 1359 sats per dollar, and fees are calm at 1, 1, and 2 sats per VByte. This week, I want to avoid getting lost in the Wall Street noise. Yes, Bitcoin pulled back. Yes, ETF flows reversed. Yes, the CNBC crowd is once again confused about whether Bitcoin is risk on, digital gold, tech beta, or whatever phrase they're using this week. But that is not where the signal is. The signal this week is much deeper. The signal is in self-custody. It's in Bitcoin mining adapting to AI and energy markets, policy fights and the Clarity Act, Bitcoin infrastructure development, and in the growing parallel economy. And the signal is in the simple fact that Bitcoin keeps producing blocks while the legacy system keeps producing debt, confusion, and political theater. So this week's theme is Bitcoin is not a trade. Bitcoin is a system of truth. With that, let's get into the news of the week. First up, we'll talk about Bitcoin price, but without the CNBC nonsense. Bitcoin fell roughly 5.5% over the week, sliding from above 77,000 to around 72,600. That's worth mentioning, but not obsessing over. The real point is this: Bitcoin volatility, it's the price of admission for owning an asset that is still monetizing globally. If you want a new monetary system, you do not get it in a straight line. You get it through waves of speculation, fear, leverage, forced selling, narrative confusion, and eventually deeper understanding. For me personally, I just think about the Weimar Germany gold chart and everything seems to make sense. Every cycle brings in new people for the wrong reasons. Some arrive because the chart looks good. Some arrive because Wall Street finally blessed it. Some arrive because their advisor added a 2% allocation. Then Bitcoin drops and the tourists leave. But the people who understand why Bitcoin matters tend to use these moments differently. They study, they stack, they check their custody setup, they revisit their time horizon. Bitcoin's price is volatile because the world is still figuring out what it is. Bitcoin's supply is not volatile. Bitcoin's rules are not volatile. Bitcoin's settlement assurances are not volatile. Moving along to self-custody, property rights, and freedom. Self-custody keeps moving into the policy spotlight. One of the more important continuing themes from Bitcoin 2026 was the idea that Bitcoin self-custody should be understood as a civil liberty. And that is exactly right. If property rights do not extend into the digital realm, then property rights are incomplete. And if individuals are not allowed to hold their own keys, then Bitcoin is reduced to another permissioned financial asset inside the old system. Self-custody is not just a technical preference, it's the entire point. It means you do not need a bank's permission, you do not need an exchange's solvency, you do not need a custodian's blessing. You do not need a government-approved database entry to prove ownership. You hold the keys, you control the money. The right to self-custody is the right to own property in the digital age. Bitcoin Magazine had a nice piece recently on the history and future of Bitcoin, physical Bitcoin, that is. This is a fun topic, but it points to something deeper. Bitcoin is difficult for new people because it is not physical. You cannot hold it in your hand. You cannot put it in a safe like a gold coin. You can't look at it and say, there it is. That creates an educational challenge. People understand houses, gold coins, cash, and stocks. Bitcoin requires a conceptual leap. You have to understand private keys, public keys, the ledger, proof of work, nodes, and scarcity without physical form. But once that clicks, it becomes incredibly powerful. Bitcoin is harder to understand at first because it's not physical, but it is also more powerful precisely because it is digital, portable, programmable, divisible, and globally verifiable. UTXO management and custody maturity are becoming mainstream Bitcoiner topics. This week is also a good moment to remind everyone that self-custody does not end with "I bought a hardware wallet." Real self-custody maturity includes understanding all of these things: backups, passphrases, multi-sig, inheritance, UTXOs, privacy, and node verification. As Bitcoin adoption grows, more people will come in through ETFs, brokerages, and exchanges, and that's fine as a first step. But the educational journey cannot stop there. Bitcoin exposure is not the same as Bitcoin ownership. Bitcoin ownership is not the same as Bitcoin sovereignty. Sovereignty requires knowledge. All right, moving into mining, AI, and energy. One of the most interesting Bitcoin native stories this week was the growing competition between Bitcoin mining and AI data centers. Fidelity noted that both the 30-day average hash rate and mining difficulty were down roughly 8 to 9% from earlier highs before modestly rebounding. The suggestion is that some miners may be redirecting power and infrastructure toward higher margin AI workloads. This is a huge story. Bitcoin miners spent years doing the hard work of finding cheap power, building relationships with energy producers, developing infrastructure, and learning how to operate in difficult markets. Now, AI companies want energy too. So, miners are facing a choice: keep hashing, sell power, host AI workloads, or build hybrid models. Bitcoin miners may become energy companies that happen to mine Bitcoin, and in some cases also serve AI compute. Another Bitcoin Magazine piece looked ahead to the future of mining and the long-term pressure of declining block subsidies. This is important because Bitcoin mining economics will keep changing. The subsidy gets cut every 4 years. Hash price trends downward over time. Efficiency improves. Fees become more important. Energy strategy becomes more important. Some people look at that and panic, but Bitcoin was designed for this. The difficulty adjustment is the shock absorber. If miners leave, difficulty adjusts. If miners return, difficulty adjusts. The network keeps targeting 10-minute blocks. Bitcoin mining is not supposed to be easy. It's supposed to be competitive enough to secure the hardest money humanity has ever had. A related piece from the Energy Mag argued that Bitcoin miners are evolving into energy-backed compute companies. That makes sense. The hardest part of modern compute is not always the servers. It is the power. Bitcoin miners already solved part of that problem. They found stranded energy. They built flexible load. They learned how to operate where energy is abundant but under-monetized. Now, AI wants that same energy. Bitcoin mining may become one layer in a much larger energy and compute stack, but Bitcoin remains the monetary anchor because it is the only digital commodity with no issuer, no board, and no discretionary monetary policy. Low fees are good for users, but challenging for miners. Fees this week are calm, around 1 and 2 sats per VByte. That's great if you're consolidating UTXOs, opening Lightning channels, moving coins to cold storage, or cleaning up wallet structure. But low fees also remind us of the long-term fee market debate. Eventually, as the block subsidy declines, transaction fees will matter more to miner revenue. This is not an emergency, but it is a real long-term topic. Low fees are an opportunity for users today and a reminder of the fee market questions Bitcoin will keep working through over the coming decades. Moving along into Bitcoin development and infrastructure. Bitcoin Optech's May 29th newsletter covered the responsible disclosure of a vulnerability that could allow a remote peer to crash core Lightning nodes. This is not a Bitcoin is broken story. It is a serious open source infrastructure requires maintenance story. Lightning is powerful, but it is complex. Node software needs updates. Implementations need review. Bugs need responsible disclosure. Operators need to stay informed. This is how real infrastructure matures. Open source Bitcoin infrastructure is not perfect. It is better than perfect. It is transparent, adversarially reviewed, and constantly hardened in public. The same OpTech newsletter linked to transcripts from a recent Bitcoin Core developer meeting. Now, that may sound boring, but it matters. Bitcoin does not have a marketing department. It has contributors, it has review, it has debate, it has conservative engineering, it has people arguing carefully about trade-offs because the stakes are high. In fiat, central bankers improvise policy in press conferences. In Bitcoin, developers argue over code changes in public because no one has unilateral control. Bitcoin changes slowly because it should change slowly. That is a feature and not a bug. OpTech also tracked regular software releases and regular release candidates across Bitcoin infrastructure projects. And again, this is not flashy, but this is how Bitcoin wins. Not through one announcement or one conference or one celebrity endorsement or one ETF. Bitcoin wins through relentless infrastructure improvement. The boring work is the bullish work. Next up, let's take a look at policy, Clarity Act, and the banking system. The Clarity Act remains one of the most important policy stories for Bitcoiners to watch. The key questions are not just, is crypto regulated, or does the market get clarity? The real questions are, does the bill protect self-custody? Does it protect non-custodial developers? Does it avoid turning open source software into regulated financial activity? Does it preserve peer-to-peer use? Does it prevent the banking lobby from quietly capturing the rules? The banksters. Bitcoiners should not ask Washington for permission, but we should absolutely pay attention when Washington writes rules that may affect developers, wallets, exchanges, stablecoins, and self-custody. And we will be watching that one closely, of course, here at the Bitcoin Fortress. A good CoinDesk opinion piece argued that the Clarity Act will not lead to real adoption without crypto tax reform. This is especially true for Bitcoin. If every cup of coffee, every small Lightning payment, every peer-to-peer transaction, and every small spend creates a taxable event, then the tax code discourages Bitcoin from functioning as everyday money, as it does today. That does not stop Bitcoin from being a savings technology, but it does slow circular economy adoption. A de minimis exemption for small Bitcoin transactions would be one of the most practical policy improvements Congress could make, but we shall see. CoinDesk also covered recent crypto and the Fed developments, highlighting the uneasy relationship between digital assets and the banking system. This is the deeper issue. Bitcoin was born as an alternative to central banking. Stablecoins, tokenized deposits, bank custody, and market structure bills all orbit around the same question. Who controls the money? Bitcoin answers differently from every other asset. Bitcoin says no central issuer, no discretionary supply, no privileged insiders, no lender of last resort, and no monetary committee. The Fed can study Bitcoin, banks can custody Bitcoin, Wall Street can wrap Bitcoin, but none of them can become Bitcoin's central authority. Moving right along to treasury adoption, corporate Bitcoin, and institutional infrastructure. Strategy's pause in Bitcoin purchases remains worth discussing, but not as the main event. The important point is not Saylor didn't buy this week. The important point is that even the most aggressive corporate Bitcoin treasury strategy has to manage capital markets, liquidity, liabilities, preferred stock, convertible debt, investor expectations. That's a good lesson. Conviction does not mean ignoring risk. Conviction means building a structure that survives volatility. Strategy is a fascinating Bitcoin treasury machine, but Bitcoin does not depend on strategy. Strategy depends on Bitcoin. The strategy story also shows that corporate Bitcoin adoption is getting more sophisticated. It is no longer just company buys Bitcoin. Now we have convertible debt, preferred stock, treasury arbitrage, yield instruments, institutional custody, and credit market plumbing. That creates opportunity, but also risk. Bitcoin is simple. Fiat capital markets are complicated. When the two meet, Bitcoiners need to understand the difference. Moving along to Bitcoin culture and global adoption. Bitcoin Ireland shows grassroots adoption is alive. A recent Times piece covered the Bitcoin Ireland conference, showing a wide range of people interested in Bitcoin as a hedge against inflation and a path towards financial freedom. That is much better signal than a single ETF flowchart. Grassroots adoption matters because Bitcoin is not just an American institutional product. It is global. It appeals to people in countries with inflation, capital controls, weak currencies, broken banks, political instability, or simple distrust of fiat money. The real Bitcoin story is not just BlackRock. It is ordinary people around the world realizing they need an exit from broken money. One thing that stood out from the Bitcoin Ireland coverage was the emphasis on education. That is exactly right. Bitcoin adoption cannot be forced. It has to be understood. You cannot orange pill someone by yelling price predictions at them. You educate them. You explain inflation. You explain scarcity. You explain custody. You explain why saving in better money changes behavior. Bitcoin education is not marketing, it is liberation. Now let's separate this from the news and talk about what the Bitcoin podcast universe has been circling around. First theme, who really controls Bitcoin? What Bitcoin did released an episode titled Who Really Controls Bitcoin with Bitcoin Mechanic. That is one of the most important questions in Bitcoin. The answer is not miners, developers, exchanges, BlackRock, Michael Saylor, or politicians. Bitcoin is controlled by the users who run nodes and enforce the rules they choose to accept. That's why running a node matters. That's why consensus matters. That's why Bitcoin is different. Bitcoin's governance is not top-down, it is opt-in, distributed, and deeply conservative. The second theme, the parallel economy, is becoming a serious topic. What Bitcoin did's recent Brian DeMint episode on Bitcoin's parallel economy is right in line with where I think Bitcoin culture is going. Bitcoin is not just an asset to hold. It is a foundation for building new economic relationships, meetups, merchants, lightning payments, local trade, food, health, family, trust, community. This fits perfectly with the Bitcoin Fortress, Bitcoin Way of Life series. The next phase of Bitcoin adoption may be less about price charts and more about building better lives with better money. Bitcoin mining and AI are converging is theme 3. TFTC and related energy-focused shows continue to cover the overlap between Bitcoin mining, AI, energy, and grid infrastructure. This is one of the biggest stories in Bitcoin right now. AI needs power. Bitcoin miners understand power. Miners can operate flexibly. AI data centers are more demanding. The two industries may compete, but they may also converge. Bitcoin mining is not just a monetary story, it is becoming an energy infrastructure story. And theme 4, macro stress keeps validating Bitcoin's purpose. Coin Stories' recent news block covered themes like Moody's downgrade of America, large corporate Bitcoin holdings, and high-profile investors changing their Bitcoin views. The broader macro story is familiar: debt, deficits, downgrade risk, political dysfunction, and declining trust. Bitcoin does not need people to believe in it all at once. It just needs the fiat system to keep doing what it does. Bitcoin is not rising because the world is stable. Bitcoin is rising because the world is learning that the old monetary foundation is unstable. All right, let's take a look at this week's featured Substack post, which is A Bitcoin Way of Life, Week 2. This series is about something deeper than Bitcoin price, ETF, or politics. It is about how Bitcoin changes the way we live. Bitcoin lowers time preference. It teaches patience. It rewards discipline. It forces you to think in years and decades. It makes you ask better questions. What am I building? What am I saving for? What kind of example am I setting for my children? Am I living by fiat incentives or sound money principles? Am I spending my life energy on things that matter? That is why Bitcoin is not just an investment, it is a teacher. And the deeper you go, the more you realize that Bitcoin's real promise is not just financial independence, it is a more ordered life. Before we wrap, I did want to mention the Bitcoin Fortress books available, links in the show notes to this, of course, and all the other news items that we covered this week. First up, Bitcoin Fortress, a simple guide to Bitcoin for beginners. This is the best starting point for someone who is new to Bitcoin and wants a clear, calm, beginner-friendly explanation. Next, we have Bitcoin Retirement and Estate Planning. This one is for Bitcoiners thinking about long-term planning, inheritance, self-custody, trusts, retirement accounts, and how to protect Bitcoin across generations. I've actually looked around and I haven't seen anything quite so focused in this particular area of retirement and estate planning, so check it out. And then there's, of course, the Bitcoin Lifestyle, and most recently, the Architecture of Money, newly published book that explores how modern monetary system was built, how fiat incentives distort society, and why Bitcoin offers a radically different foundation. You can find them all on Amazon. Well, folks, that's it for episode 218 of the Bitcoin Fortress podcast. This week reminded us not to get distracted by surface level noise. Yes, price moved. Yes, ETFs had outflows. Yes, Wall Street changed its mood again. But Bitcoin kept working. The blocks kept coming. Nodes kept validating. Miners kept competing. Developers kept developing code. And educators kept teaching. Families kept stacking. And communities kept forming. That is the real story. Bitcoin is not a trade. Bitcoin is a system of truth. Stay humble. Stack sats. Hold your keys. Run your node. Teach your family. Build your life on something stronger than fiat promises. This is Bitcoin Fortress, building one block at a time, and I'll see y'all next week. Bye-bye.